Elfreda Jonker. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Stephane André with me. He's one of our co-founders as well as a portfolio manager in the domestic team and the analyst on the commodities sector, which we will be discussing today. So Stephane, it's been a bit of a roller coaster for commodities as usual, I guess, but let's start all the way back to September 2025. What happened when that really big reversal into commodities happened in the market?
Yeah, I mean, it started then, you're right. That's when we reversal had, but the whole setting for the reversal, or actually kind of the biggest kind of rotation into resources, the foundation started happening actually a few months beforehand. If you recall, kind of April 25, we had Trump announcing on Liberation Day a huge amount of tariffs around the world, and big ones on China was a massive escalation, and everybody was concerned that eventually that would mean inflation and lower growth, so that's not too good for commodities. And in September, when the expectations for commodity prices had been put down, and actually the demand outlook looked less affected because all these big tariffs got reversed. Remember the 145% with China kind of eventually got reversed to much lower levels. Yes. So demand was a bit better than expected. China came in with this anti-involution and policy which restricted a bit the supply, but then you had also supply disruptions around the world, and the US dollar weakened. So you had the perfect cocktail at that time of having better demand, worse supply, US dollar weakening, and expectation, very importantly, set very low. Yes. So that's when we saw the rotation, and that rotation was one of the biggest rotation we have seen in the last 20-30 years in resources.
Yeah. So that was a fantastic time to follow that sort of earnings leadership as we like to do into that sector. And then fast forward to 2026. Tell us what has played out in the commodity space this year so far.
Everything was strong till February. We started selling down a bit the resources because of the concern that things were so strong that we needed to take some profit out. They were becoming a bit more expensive. But then we had the war in Iran, and
Project Fury.
That's right, and something which was supposed to be only a few days kind of took a bit longer, and global growth started to be again concerned, especially because of the inflation risk that the energy shock coming from closing down the biggest channel of energy, 20%, would have on the economy. Oil price lifted, not to the full extent because of the reserves which were kind of released, but that started putting a lot of concern. We felt, so we had reduced quite significantly by then the commodity exposure, and were ready to move into defensive if we went into recession, but ready to step back in. Then when the truce was announced a week ago, as we record today, by the way, the bombing has restarted, so who knows, but we were expecting that the reopening or the truce there would mean that you would have commodities running again. But what happened instead is that the new Fed chair kind of basically had a pretty hawkish stance on inflation, needed to control it, and the US dollar went up. Yes. And that's not good for commodities. Yes. So the first reaction is prices of commodities went down despite the better growth prospect. Yes. So where to from here? Yes. Where to from here is that expectations are high, because in the rally everybody lifted expectations of commodity prices. Some of these commodity prices in the recent correction mean that we are sitting now below consensus, and therefore there's earnings downside risk. And that's a concern for us when that happens. Now, that is a flag. The second flag is the whole inflation side, but not sure that we're going to have really a US dollar strengthening ongoing strengthening from here, because if energy prices fall, eventually you would think that inflation would be less of an issue, and therefore you might have a US dollar weakening, in which case commodities look attractive enough. But now, the fact that we still have a strong US dollar, the fact that the Fed stays hawkish, the fact that for some commodities we have downside to earnings, we have a far more moderate position.
Yes.
It's a low overweight at this stage. And I think that's probably kind of right, especially given the conflict and inflation tension.
Still a lot of uncertainty playing out in
Yeah.
markets. And if we dig a little bit deeper into the specific commodities that you're referring to, please tell us which ones are currently looking a bit more attractive from that spot versus expectations perspective.
Yeah, I mean, copper has looked attractive for a while. Costs are lifting, grades are falling, and the whole energy transition means that we will need copper, AI, data centers, and so on. And the supply is pretty weak. So I think that copper remains quite attractive. Lithium has had a push up on the back of China wanting to have more kind of battery energy devices to kind of firm the grids. But also the whole war with Iran kind of reinforced the need to move away from oil and gas. So I think there the demand has also kind of increased. So these two for the moment look actually pretty good. But we always have to measure the pulse of where are the expectations and how is demand supply playing against it.
So let's start talking about portfolio positioning in this space, and with the two biggest players, BHP versus Rio. You currently have a preference for BHP, which clearly aligns a bit to your commodity views, but explain to us why BHP over Rio at the moment.
I think both are well positioned from a operational perspective. Both have good growth ahead, not terrific growth, but kind of nevertheless growth. Solid balance sheets. In the case of Rio, there's also a new CEO, which is probably going to announce further cost cuttings and asset sell downs. But BHP feels like it's humming. Operations are doing well, probably better than Rio. My main concern about Rio is the Glencore deal. That with seeing the number of investment bankers trying to convince us that it is actually a good deal, I suspect that it's going to come back on the table. And what it does, it typically puts pressure on Rio, lifts Glencore again. And there are some aspects of that deal which I don't like. I don't think marketing will be well managed in the hands of Rio, and that's a big percentage of that business that they would be going with. So it depends, of course, of the split, of how it's kind of positioned, who runs it. But for us, that's a noise which we don't need right now, when we can have an exposure which is clean and doesn't have that noise. So BHP over Rio at this stage.
And then finally, I know we have expanded our exposure to commodities a little bit broader. Some of the names that's recently been added, mineral resources as well as BlueScope steel. Can you tell us why you like those two specifically? Yeah,
very different exposures. Mineral resources, we added it mid last year, more or less. And that's very much a deleveraging story. The stock had a EV to EBITDA of more than 6 times, and now it's close to 2. A bit of luck because lithium price went up and iron ore price went up, but also good operational levers. And they ramped up Onslow, which is a 35 million tons iron ore mine, and that's kind of bringing a lot of cash to the company when it needs it, really. And then you have had also the sell down of some of the lithium assets. They still have good exposure to it, but they've sold down 30% to POSCO. Why we still like it, we still think that it has good operational momentum. The commodities, we still support it for these months. And we think that it can still kind of play a few tricks out of the pockets in terms of mining services contracts, which would be surprising the market positively. So it's not a big exposure because of the CEO succession risk, but nevertheless it's an exposure. BlueScope is very different. BlueScope, it's really a play on the US spreads, steel spreads, which have increased by more than 50% over the last few months. And the reason why they have increased is the tariffs in the US to prevent the import of steel have been pretty high and effective, and we're seeing really the imports going down when the demand for all the data centers is going up. So you have steel prices going up, the spreads expanding significantly, which means that the earnings for BlueScope are expanding quite a lot. On top of that, they've had a bid from 7. The share price is trading in just around the bid, and the new CEO, Tanya, pretty sure she'll kind of pull all the levers possible to kind of show that there's more value. Plus, they have these earnings kind of tailwind, which is likely to last for a while. So it feels like a good position.
Well, thank you, Stephane, for all your insights there. For more information from Stephane and the team, please visit us on alphinity.com.au. Thank you.